to this session at the Advanced Room. I would like to welcome everybody who is in the live at XM Live and watching us, but also those who are watching us from YouTube. XM Live is a program where we live stream every single day on 3 different channels, 8 hours, where there are more than 12 trading experts with multiple year experience, and they show you exactly how they trade, how we trade. It's not they, it's we. I'm also part of it. And you can join for free. So in the bio of XM Global, you will find the link. You can sign up and you can join us. My name is Gil, and I'm here this hour with Stan, and we are this is the trade of the week session, and we will promise you at least to open one trade market, not limit order or anything market, and we try to stay within 1 week in the trade. Stan, how are you doing?
That's right. Gil doing pretty good. Had a good trading experience from Monday up until last night. Today is also starting pretty good. Have some pound long positions from the pullback earlier today. Anticipating maybe some hawkishness from Bank of England, I could expect some 6-3 descent that might guarantee September hike. But before we get there, how are you doing?
I'm doing also very good. Um, I think exciting Fed meeting yesterday, even though it was a non-decision. Anyhow, I'm very excited about the new Fed president. I think he started some very interesting processes. We still don't know if the outcome will be good, but I'm very, very optimistic about it. And yeah, also like trading at the moment. It's working fine for me in this environment.
What was your impression from last night? Um, what did you get from last meeting?
No, so yesterday's meeting, it was in the sense a non-event that they didn't make any changes, right? And interestingly, and I think we have to start to be prepared for that, because in the era of Powell and before Janet Yellen and Bernanke, when there was forward guidance, they prepared the market already in advance what they will do. Now this is not happening, and we saw on the FedWatch tool before the decision a third priced in a rate hike yesterday already. And then obviously when you have this difference and there is not
We saw it
90%.
in the prices of different instruments as well. We saw it all over the place. We see it
Yes,
yes.
so we get higher volatility, and this is something we can prepare for. Now, Kevin Warr said, look, this is not the goal. The goal is not to bring high volatility into the market. The goal is to make monetary policy more efficient. And I think it's time to do that. I mean, the models that the Fed is using often are a couple of decades old, and they used in the past not very accurate data sets. And I think it's time really to review everything and to question everything and come out with, 2026 new targets, which they don't change from today to tomorrow, but I'm very optimistic that they will. So I like a lot what is happening there. I like the discussion. I like the disagreement. There was a 9-3 quote. I like that there is. So I think, especially for us trader, it's good to have high volatility. But in the end, also, I believe it's showing again and again that the Fed, the US Federal Reserve, is one step ahead of everybody else. And I think ECB maybe and others, they will follow up with that in
Your
the
answer
future.
is a little bit like Kevin Warsh's answers last night when I asked you about what you get
Yeah,
from it.
because I absolutely agree what he's saying.
But he didn't say anything. He was contradicting himself on multiple questions. He said the market they didn't do much in 40 whatever 45 days, but the market have been reacting very well recently, and they have been observing that. And then when later on they ask him, okay, so the yields are going up, and this is a signal for market for you to take action, right? To maybe hike rates and get closer to the bond yields. He answered that, yeah, but we are not going to rely on foreign markets in our decision-making process. So, which was completely everything he said so far, he completely erased it with the last word. I'm not saying that you did that. No, no, if you don't get me wrong. But like you are supporting this type of what information you're gonna use later on.
No,
Then
but I correct a little bit. He said, yeah, the market is one of the data sets that we are using, and the market is not always right, but sometimes it's more right than the Fed. So they look at just much more broad. Now, for me, the key event was when quite at the end, and I think this is exactly the time when the market started to turn around, because in the beginning, yields came down, stock market went up when there was no rate hike, and during the press conference, quite strongly stock markets went up, and then in the last 10 minutes it turned around. And by the way, yields are now again 4.7. We are in a very, very dangerous zone for stock market. But in the end, there was a question that said, okay, you are saying the Fed, that inflation is a choice and that you will defend your target, but you didn't do anything today. Why didn't you do anything? So why do we meet here? You're just talking. And he said, who says we didn't do anything? You see, yields are moving. And he talks obviously on the long term end. And it made me something realize and suddenly understood. It's not a secret that Kevin Walsh, he wants to deal with the balance sheet. The balance sheet, if I can share it here, this is what
but
we are talking
he
about.
doesn't say anything about that.
So let me explain what I think it says. The balance sheet, in the end, what you do with that, they're printing money and they're buying long-term yields. So actually what he was
Bonds.
saying, not directly, but this is what I understand he was saying, is, look, what happened is that blowing up this balance sheet, the Fed controlled both ends, the short term and the long term, because they were buying actively and intervening in the long term yields. And this was playing on both sides, and maybe we have to reevaluate it. And if we give the long-term yields back to the markets, and you already start to see that something is happening because yields are going up. So he says, okay, that's already a tightening. It's not that we didn't do anything and not tightening. If we are not intervening and long-term yields start to go up, we already do something. Because if yields continue to go up, the huge CapEx costs that we are having from all the hyperscaler, they will, and if, I mean, Google starts to have, they have to start to issue bonds, and they don't have any cash anymore in their company. So to issue bonds, it will become more expensive. That will lead to that they can't do so much capex anymore, which brings inflation down. So by not intervening with the balance sheet anymore and not playing with that and actually going out of that market, they're giving the long-term yields back to the markets, and that's already an act. That's what he was hinting in the end, and that immediately moved the market drop after that quite strongly. And I think this will be a major theme for the months to come and the years even to come. And I think that's really not bad. So, and he mentioned that many times, he said short term, the Fed main tool was always the short term interest rate, but there is more tools. And so by not intervening in the long term, it's actually a lot. Oh, that's my take. I might be wrong again, but I saw also the market reaction directly on that. And I think that's a real thing. By the way, if you look at the 10-year yield, I have a screenshot here. We are at 4.7%, I believe. We are going out. This is daily chart. We have here a triangle. We are breaking out of the triangle on the upside. And again, this is bad for the stock market. And it's tightening in the end. It's long term. It's the long end tightening, actually, made by the market, not by the Fed. So that's my take here. That's how I see how he starts to see it. Again, he didn't say it directly, but this is how I read his words.
I'm not. Yeah, probably have to watch it again to see it in this perspective because I have observed different type of an event. I think um, he really wanted to answer questions, but he didn't have much to offer. Maybe I'm not too smart to read between the lines. But on a lot of questions, he was just answering more like a motivation speaker rather than anything else to me.
That's true, and I think this is part of the new way because he don't want to give forward guidance,
But
right?
yeah,
Because
but he was giving like we're gonna do this, it's gonna be good. You know, it just you don't provide much. Yeah, it just was like more of a Steve Harvey type of, you know,
yeah,
or
because
Jim
really
Rohn type of pump.
he didn't have to offer. He just started the task force. He said he waits for the results. What do you want me to do? I mean, this is the second meeting. Um, he said we had a discussion about inflation and how we attack inflation the best. And again, there is you can attack it on the short-term yields and you can attack it on the long-term yields. And there was a broad discussion how to do it best. Um, I think they're not in a hurry because really, and they mentioned three sources of inflation, right? The first source of inflation is high energy prices. The second source was high capex, and the third one now I forgot. I just had it in my head and now it just ran away.
That's
but
all
but
right.
o- but the capex I would say is the only one that the Fed can control. And the capex. So how you do restrict capex? And I think normally they take long-term bonds, right? They issue bonds in order to spend that, and this is more long-term. And I think this is the direction he wants to go. Now, again, he needs to get a consensus from the committee. He's not the only one who is deciding, but seems to me that this is the way that he wants to go. But again, he said, look, the task forces have to come back. We want to review all the data that we are looking at. He said, look, until now, we looked at very old fashioned data. You can't expect after 8 weeks already, huge changes, and you don't want to make a mistake, right? And they're not in time pressure. And he mentioned that many times. He said, look, we are 63 months over the target. So another 2, 3 times, it's not the end of the world. We will start to attack it, but we want to attack it with confidence. Let us do the job. And I think it's quite a prudent approach. So I'm obviously, we don't know the result yet. They could make also mistakes. That's always a possibility. But I think it's quite interesting what is happening. Now,
I
in
think it will be getting interesting in terms of the volatility that we'll be getting,
yes,
but I generally believe that balance sheet reduction and cutting interest rates in the long term is going to be disaster
I
because
don't know again.
when they have to cut rates, they will have no room to do it.
I'm not sure that they will cut rates. They can also keep rates at the same level. And in the balance sheet, if we go to 4.8, 4.9, 5%, there will be a natural tightening process. When the long-term yields go up, they will become more competition for the stock market. The capex will become much more expensive, and that's a way to tighten, right? Yes, it will
Tighten
create.
what? To tighten the stock market? or what?
Yeah, to tighten capex, because again, if we look at inflation, what the Fed can create, like if you look at the inflation that is above the target, so you have to go back. Energy prices, it's not in the control of the Fed. What can they do with it? Even if you tight, if you raise the rates, it doesn't change energy prices. It's a totally other topic.